The money paradox. Right now, there is more money in the world than at any point in human history. Trillions of dollars, trillions of euros, circulating through banks, markets, and financial institutions. Central banks have been pumping massive amounts of money into the global economy for years. Interest rates are close to zero in many countries. Loans are cheaper than they've ever been. In theory, this should make everyone richer. More money should mean more investment, more growth, more opportunity. But strangely, many people feel the opposite. Savers are earning almost nothing on their bank accounts. Housing prices are exploding. Wealth inequality is widening. And despite all this money, entire parts of the economy still struggle to get funding. So the big question is, where is all this money actually going? And why does it feel like the financial system benefits a small group at the very top? To understand what's happening, we have to look at how the modern financial system really works, and why many economists believe we may be living inside a massive financial experiment. The age of cheap money. For decades, the financial system followed a relatively predictable pattern. If you saved money in the bank, you earned interest. If you borrowed money, you paid a noticeable cost. But everything changed after the global financial crisis of 2008. When the crisis hit, governments and central banks were terrified of a complete financial collapse. Major banks were failing, credit markets froze, and global trade slowed dramatically. To prevent a depression, central banks launched an extraordinary response. They slashed interest rates to near zero. They bought government bonds and financial assets. And they pumped trillions of dollars into the financial system. This strategy was known as quantitative easing, and its goal was simple: make money so cheap that businesses and consumers would start borrowing and spending again. At first, the policy seemed to work. Markets stabilized, banks survived, economies slowly recovered. But as the years passed, something unexpected began happening. Instead of flowing evenly through the economy, the new money started concentrating in very specific places. And those places were not always the ones policymakers had hoped for. The end of saving. For generations, saving money was considered the safest financial strategy. People deposited their earnings in banks, earned interest, and slowly built financial security over time. But today, that system barely works anymore. In many countries, savings accounts offer interest rates close to zero, sometimes even lower than inflation. Imagine putting 10,000 euros into a savings account and earning just a few euros per year. At that rate, your money isn't really growing, it's slowly losing purchasing power. This creates a huge dilemma for millions of people, especially retirees who depend on interest income. The traditional strategy of saving responsibly and living off interest has largely disappeared. Instead, people are increasingly pushed towards investments they may not fully understand. Stocks, real estate, financial markets, even if they never planned to become investors. The result is a world where ordinary savers feel trapped between two choices: accept losing money slowly or take risks they may not be comfortable with.
A world running on debt. At the same time, borrowing money has become incredibly easy. Governments borrow trillions to finance spending. Corporations borrow to expand operations. Investors borrow to buy assets. Debt has become the fuel of the modern financial system. Today, global debt across governments, companies, and households has reached astonishing levels. Hundreds of trillions of dollars. Much higher than the size of the actual global economy. But the most surprising number comes from a corner of the financial world most people rarely hear about: derivatives. Derivatives are financial contracts that bet on the future value of assets like stocks, interest rates, or currencies. And the total value of these contracts is estimated to be more than $700 trillion. That's nearly 10 times the size of the entire global economy. Most of this money doesn't represent real goods or services. It represents financial bets. Money being used to make more money. This shift has transformed the financial system into something very different from the economy many people imagine. The rise of asset bubbles. One of the clearest consequences of cheap money is the rapid rise in asset prices. Stocks have surged. Real estate prices have exploded. Luxury assets like art and collectibles have soared in value. When borrowing money is cheap, investors can easily take out loans to buy assets. As more investors compete for those assets, prices climb higher. This creates a powerful cycle. Rising prices attract more investors. More investors push prices even higher. And those who already own assets see their wealth grow rapidly. But those who don't own assets, especially younger generations, are often left behind. Housing is one of the clearest examples. In many major cities around the world, property prices have risen far faster than wages. Homes that once cost a few $100,000 now sell for millions. For young families trying to buy their first home, the dream of homeownership can feel increasingly out of reach. The global real estate game. In cities like London, New York, and Vancouver, real estate has become more than just housing. It has become a global investment. Wealthy individuals and investors from around the world purchase properties not to live in them, but to store wealth. Some apartments remain empty for months or even years. They function more like financial assets than homes. In some cases, properties are owned through offshore companies, making it difficult to know who the real owners are. This influx of global money drives prices even higher. But it also creates tension in local communities. Residents find themselves priced out of neighborhoods they grew up in. Cities risk becoming places where only the wealthy can afford to live. And when real estate becomes primarily a financial investment, the stability of housing markets becomes more fragile. Because if investor confidence changes, prices can fall just as quickly as they rose.
Corporate buyouts and financial engineering. Cheap money has also transformed the corporate world. Private equity firms now use enormous amounts of borrowed money to acquire companies. These deals are called leveraged buyouts. The strategy works like this. An investment firm contributes a relatively small amount of its own money. Then it borrows much larger sums from banks. Together, that money is used to buy a company. If the company grows or becomes more profitable, the firm can sell it later for a huge profit. Sometimes the returns are extraordinary. But there can be consequences. To increase profitability, companies often cut costs, reduce staff, or restructure operations. Employees can become part of the financial strategy. And businesses that once focused on long-term stability may begin focusing on short-term financial returns. How money is actually created. Many people believe that governments create most of the money in the economy. But in reality, the majority of modern money is created by banks. When a bank issues a loan, it doesn't simply lend money that someone else deposited. Instead, it creates new money electronically. When you take out a loan, for example, a mortgage, the bank adds that amount to your account. New money enters the economy. In return, you agree to repay the loan with interest. This process is known as credit creation. And it means that money and debt are closely connected. When more loans are issued, the money supply expands. When loans are repaid or defaulted, money disappears. This system has allowed economies to grow rapidly. But it also means that modern economies depend heavily on continuous borrowing. If lending slows dramatically, economic activity can slow as well. The shadow financial system. Alongside traditional banks, a large and complex financial network has developed outside the regulated banking system. This is often called shadow banking. It includes hedge funds, investment funds, and other financial institutions that move enormous amounts of capital, but operate under different rules than traditional banks. These institutions often seek higher returns than conventional investments can offer. And when interest rates are very low, the pressure to find profitable opportunities becomes even stronger.
This can push investors towards increasingly complex and risky financial strategies. Before the financial crisis of 2008, many of these risks went unnoticed. When the system finally cracked, the consequences spread across the entire global economy.
A system built on confidence. At its core, the financial system depends on something surprisingly fragile: trust. Banks trust that borrowers will repay loans. Investors trust that assets will maintain value. Markets trust that financial institutions will remain stable. As long as that confidence exists, the system functions smoothly. But if confidence breaks down, even temporarily, the consequences can be severe. Credit can freeze. Markets can crash. And the ripple effects can spread quickly through the global economy. The crisis of 2008 demonstrated just how fragile the system can be. And despite new regulations, many economists argue that the fundamental structure of the financial system has not changed dramatically since then. The big question. So today, we find ourselves in a strange situation. The world is flooded with cheap money. Debt continues to grow. Asset prices continue rising. And yet, many people feel financially insecure. The system rewards those who already own assets, while savers and younger generations struggle to keep up. The question facing economists and policymakers is not simply how to create more money. It's how to ensure that money flows into areas that benefit society as a whole. Innovation, infrastructure, sustainable businesses. The future of the global economy may depend on whether financial systems can shift their focus away from pure speculation and toward real economic value. Because history has shown that financial systems built on ever-expanding debt eventually face a difficult moment. A moment when the cycle slows down or stops. When that happens, the world will once again be forced to answer a question it has faced many times before. How much debt and how much money can the system really handle? And what happens if the answer is less than we expected?